Okay, let's get into this. We are diving into a world that's run by um, these invisible laws. They're written by technocrats in secret meetings.
And these rules affect everything. Every loan, every mortgage, really every financial crisis since the
We're
80s.
talking about the Basel Accords, and they're created by the Basel Committee, which meets at the Bank for International Settlements, the BIS, in Switzerland.
The setting itself tells you so much about the power they have. The BIS headquarters is this brutalist, cylinder-shaped skyscraper.
Right, I've seen pictures. It looks like something out of a spy movie.
It basically is. It has the legal status of an embassy, its own police force, and its officials get full diplomatic immunity. It's like a sovereign state just for money.
And why does that matter to you? Well, understanding these accords, it explains why your mortgage application might get denied. And maybe more importantly, why the 2008 crash happened the way it did.
The whole origin story is key. It really starts back in 1974. A German bank, Bankhaus Herstatt, it just collapsed chaotically.
What happened?
Because of time zones, it closed its doors before paying what it owed to banks in the US. The entire global system just froze instantly. The G10 leaders realized there were no standard rules of the road.
And that panic is what led to the Basel Committee.
Exactly. So fast forward to 1988 and we at Basel I. The core idea was this capital adequacy ratio. Banks had to hold 8% capital against their risk-weighted assets, or RWA.
Simple enough on the surface.
On the surface, yes. But the distortion was all in the weighting. A corporate loan was weighted at 100%, a residential mortgage, just 50%.
And government debt.
That's the kicker. Government bonds were assigned a 0% risk weight.
Zero. So just officially declared risk-free.
Completely. And that one little mathematical choice, it warped the entire global economy. It created this just insatiable demand for sovereign debt.
And it pushed banks away from lending to actual businesses, right? Because why take the risk when you can just buy risk-free government bonds?
Precisely. And it fueled the housing boom. Since mortgages required half the capital of a business loan, the whole game was rigged from the start.
But the world got more complex, so I guess they felt Basel, that was too simple. That's why we got Basel II in 2004. They were trying to get it right.
They were, but they made two just fatal mistakes. First, they essentially outsourced the safety of the entire system to three private companies, the credit rating agencies, Moody's, S&P.
Hold on. So the official regulators just decided to trust the ratings from a handful of private firms?
They did, and the second mistake, they introduced what they called the internal ratings-based approach, the IRB.
Which means?
It allowed the giant banks, like JP Morgan, to use their own computer models to calculate how much risk they were taking.
That sounds insane. That's like letting students grade their own exams.
Functionally, it was, and, surprise, surprise, the models always came back saying we're incredibly safe, which let them shrink their capital buffers to almost nothing.
So Basel II basically gave them a scientific-looking permission slip to load up on what we now know was AAA-rated subprime junk.
It was the green light for the 2008 implosion.
So after that disaster, we get Basel III. The response was to just double down on the rules.
Double down, yes.
Yeah.
They added tough new rules like the liquidity coverage ratio, or LCR. This was born directly from the trauma of watching Lehman Brothers literally run out of cash.
Okay, so what did the LCR do?
It forced banks to hold a huge stockpile of what they call high-quality liquid assets, HQLA, enough to survive a 30-day panic.
And let me guess what counted as the best HQLA.
You got it. Government debt, U.S. treasuries, German bonds, the gold standard of safety.
So that creates the famous doom loop. The safety of the banks is now even more tied to the safety of the governments.
Absolutely. We saw the rigidity of this in the 2019 repo spike. The market was seizing up, it needed cash, and JP Morgan was sitting on billions.
But they wouldn't lend it.
They refused, because lending it out would have pushed their LCR below the regulatory minimum. The rule acted like a straitjacket, forcing them to hoard cash right when the system was desperate for it.
And the risk didn't just go away, it just moved right into the shadows.
That's the supreme irony. By making regulated banks so rigid, all that risk-taking migrated to the unregulated shadow banking system. Private credit funds like Blackstone and Apollo. They're driving the economy now, but they're totally outside the control of that tower in Basel.
And we're still left with the original flaw. The whole thing is built on the idea that government debt is risk-free. I mean, the collapse of SVB in 2023 showed how dangerous that is.
SVB did exactly what the Basel playbook told them to do. They bought safe government bonds. But when interest rates shot up, the value of those bonds crashed.
And the really wild part is that the rules let banks pretend those losses don't exist as long as they classify the bonds as held to maturity. They're hiding billions in losses in plain sight.
It's institutionalized fantasy. I think the key takeaway is that the Basel Accords have created a financial monoculture. The system is incredibly strong against the last crisis, a 2008-style mortgage meltdown, but it's incredibly fragile against the next one.
Whether that's a sovereign debt crisis or something else entirely.
Right. In the Basel dialect, strong just means you're stuffed to the gills with government debt.
So I guess the final thought to leave you with is this. The rules are designed to protect the system, to protect the banks from you. But are they designed to protect you from the ultimate risk they've created? The fantasy that sovereign debt can never, ever fail.